Good morning, everyone. Welcome to Windsor Brokers live daily market outlook. Today's Friday, 25th, of January 2013. We are at the end of another week with the highlight of today's trading, especially at the beginning of the European session, is Euro's final break higher. The euro-dollar broke briefly above psychological and strong 134 barrier, while euro-yen surged even more, hit 21-month high this morning at approximately 121.50, aiming higher and looking most likely for a test of levels above 123, which is the high of 2011. A positive tone dominates, and the signal currency continues to ignore bad news and only accept the good news. Yesterday's releases of PMIs were the key of the current movements that basically started with Chinese PMI data 2 days ago, and then followed by a rather disappointing, first of all, Spanish unemployment that came at 26%, and a negative reading of the French PMI data. But the picture has improved after release of German and the Eurozone PMI data that came in better than expected levels, accompanied, of course, with the United States release of PMI seen yesterday, that overall give some more positive tone and signal, giving basically tentative signal of quicker and swifter recovery of the world economies. These are the highlights. As I said, that better than expected, the Chinese, US, and German data gave signal for a swifter recovery of the world economy, with another positive signal coming from US jobless claims that came at 330,000 yesterday. This is the 5-year low, despite the expectations to return back to 360 from 335 of the previous week. That was the initial forecast. Dollar yen is again a top performer, as recovery of 88 base, where the support was found, and base built cleared the 90.00 as psychological 90.23 previous high, and hit fresh 2.5-year highs so far at 90.67, resuming its larger uptrend with the signal, with the confirmation of the end of the near-term corrective phase from 90.23 to 88.05. From the other side, the comments about the recent Bank of Japan's action were brushed by Japanese authorities as criticism that aggressive easing by the Bank of Japan could trigger competitive currency devaluations. Central Bank said it's trying to end nearly 20 years of deflation and not to manipulate the Japanese yen. Japanese Prime Minister Abe called for aggressive action by the Bank of Japan, which has prompted a slide in the Japanese currency, and this action raised alarm in Europe. It could contribute to a so-called currency war as other central banks adopt similar policies. Now Japan might have to defend its action at the G20 meeting of financial leaders in next month of February 15th and 16th to stem the criticism of its grand plan to revive the country's economic fortunes. As said, the euro-dollar ignores bad news and breaks above psychological 134 barrier. Of course, a lot action higher is needed to confirm the breakout, as ideal signal would be today's weekly close above this barrier. That will be signal for some for the resumption of the larger uptrend of the euro-dollar. As said, Japanese yen posts fresh, I would say, low against the US dollar, or this should be written as dollar yen, holds for now stable above 90 level. The current level is at around 90.57, with the US dollar being broadly lower at the beginning of European session against most of majors, and the dollar index currently at 79.86, with the session low seen at 79.83, posted earlier in the negative, showing a negative tone in the near-term technicals. From the commodities, crude oil, recovers ground after dipping 2 days ago to 94, 95, 95 level. Proves to be a good support for now, as the price bounces higher yesterday to 96.66 with current price action still holding above 96 level, and again seeing more focus towards the upside boundary of the recent consolidation at 96.90. That of course sees the price eyeing the $100 per barrel that we mentioned in our previous sessions. And from commodities, gold is still under pressure. Fresh low posted this early morning during the Asian session at 1663 that cracks the 1666, 1664 support, now giving more potential for further easing and keeping our initial targets at 1700 out of reach. For now, brief corrective action being capped so far at 1672, and likely scenario would be further easing as near-term structure remains weak from the technical point of view. From today's calendar, another important release is IFO Business Climate for January from Germany that is due at 9 o'clock GMT. Basically, if the release comes according to the forecasts, or even better, 103.1 is today's consensus compared to 102.4 in December, then we might be talking about another signal of fastening and increasing the speed of the recovery of Eurozone. That will be another positive signal and would give additional boost to the single currencies. Important release is from UK at 9:30 GMT. Fourth quarter GDP forecast is seen at minus 0.1%, disappointing compared to 0.9% of the release of the third quarter, and this is another. This could be another signal for possibly the British economy entering sliding basically in the renewed recession, as the release basically will give us more clues whether the economy of Britain will shrink again this last year, and this will raise the risk of heading into third recession since the 2008 financial crisis. As said, forecasts are quite negative compared to the previous release, and this is one of the most important releases for today, along with the Canadian inflation data that are due at 13:30 GMT. CPI is expected unchanged at minus 0.2%, while the core CPI for December is forecasted at minus 0.2% compared to unchanged November's release. And the last release for today is the new home sales from United States at 1500 GMT. Slight improvement seen on 387,000 units forecasted compared to 377 units in the month of November. And basically this is all from the news and the technicals. Friday is the last day of the week, usually provides a lot of action, and especially in light that coming week, next week, we have quite big releases. First of all, we will be FOMC's monetary policy and the rate decision, and of course the later in the week, next Friday, will be the U.S. non-farm payrolls data that of course promise a lot of action in the markets in the coming days. So we will stay tuned and keep monitoring markets to find the best opportunities for our trading. From the technicals, we're going to take a look now and see what's going on in the markets. Starting with the single currency, ADX shows that near-term bulls are fully back in play, as good support and base at 134.65 held the downside, and today's recovery finally breach first 133.70 previous high, and then 134.00 barrier, extending so far to 134.17. This is promising more action during the day, as near-term structure is positive. As we can see, the 4-hour indicators now firmly broke into the positive territory and all pointing higher, seeing potential for extension towards our next upside targets, which is 134.85. This is the high of 2012 from February. 134.90 is the 50% retracement of the larger 149.38 to 120.42. We are in the weekly chart, so you can see that this is longer term action, and weekly 200 days moving average at 135.25. So we have the good resistance zone at between 134.85 and 135.25, seen as the next upside target. Again, to repeat, weekly close above 134.00 is required to confirm the final breakout of the 2 weeks, nearly 2 weeks congestion under 134.00. That has been contained at 132.60.50 zone, and the fresh strength now is signaling a break above and resumption of the larger rally from 129.96 low of 4th of January, yearly low for 2013. From the other side, the cable remains under pressure despite current corrective action that brings hourly bulls back to play, but loss of initial support and near-term base at 158.00, with the basing attempt and the recovery attempt failing at 158.91. 159 zone proved to be quite a strong barrier, and subsequent reversal accelerating losses on break below 158 tested our initial support at 157.55. With brief consolidation from yesterday seen around this level. Beginning of European session brings some more positive tone for the British pound as the price action cracks initial resistance, pardon, at 158.00, where we also have 55 days exponential moving average. This is basically the initial resistance. More action higher requires a break, I would say 61.8% retracement at 151.39 and the 158.49 recent peaks of these are the yesterday's highs basically, and break above here would avert immediate downside risk. However, unless we clearly break 159.00, the focus will still remain at the downside, and the current bounce would be seen as corrective action with weekly close below 158 to confirm the negative structure of near-term negative structure, and see possibility for further extension lower with the targets seen on the downside at 157.00 as around the figure support, and close to 61.8% of the larger rally from 152.67 to 163.80, and this is seen as the next downside target in case of clear break and close below 158.00. On the upside, as we said, the 159 offers quite strong resistance, reinforced by 200 days moving average, and only break above this level would provide relief and avert immediate downside risk. But set the negative readings on the near-term studies, especially that the price action broke below 4 months range floor at 158.26 and also lost psychological 158.00 support, now sees more space for the further easing and further retracement of the larger rally, with, as we said, 159 zone seen next, close to 61.8% Fibonacci retracement. Said the introduction, dollar yen is continues its ride after a corrective pullback, better shown on the 4-hour chart. Corrective pullback from 90.23 found ground at 80.05 with 80.00 as psychological support, and ahead of high low at 87.78, offering good support before the price bounced higher. Initially, we had a barrier set approximately 89.50 and then 90.00 break of these levels, and the eventual break above 90.23 resulted in the fresh strength to 90.67 so far, with the positive tone dominating on the lower and larger time frames, despite quite extended daily structure and initial signals of bearish divergence. Still, bulls are holding firm and looking for extension higher, where we have 91.00 and possible extension to 92.00 not ruled out, as the recent rally broke above our next target that was at 90.39. That marks a 76.4% Fibonacci retracement of the larger 2010 high at 94.97 to 2011 low at 75.55, confirming the longer term base at approximately 75, 76 zone, and looking for the further retracement. Basically on the larger picture, of course, 94.97 is seen as the key upside level, break of which is to confirm the base and probably to look for some stronger recovery of the larger longer term downtrend, the last one seen from 2002. So we're talking about 10 years descent from levels at 135 zone posted in January 2002 to the lows of 2011 at 75.55. And the dollar Swiss is losing traction as consolidative rather than corrective action above base at 92.70.80 zone failed to benefit of bounces higher. The highest seen is 93.23. The pair failed to sustain gains above 93 psychological barrier. This is approximately around 50% retracement of the larger, pardon, at that point that was a bit less. If we go back to the previous lows, it's around between 38 and 50% retracement where the gains were capped, and the fresh weakness briefly broke below the 92.70 support and 92.63 seen so far. That of course weakens the near-term structure as 1 and 4 hour indicators are now in the negative territory. Still a clear break below this and the 92.86 that marks the 55 days exponential moving average is required to confirm a break and open way for possible stronger reversal of recent peak at 93.87. The good indicator will be weekly close below 92.80.70 zone. That will be another firm signal for possible further retracement with the 92.48 50% retracement of 91.09 to 93.87 seen as the next target ahead of 92.15 61.8% Fibonacci retracement and 92.00 as round figure and psychological support. Conversely, upside is still well protected, and the initial barrier it's at 93.00 and then 93.23. I do apologize. 93.23 recent peak break of the near-term congestion tops, which is approximately 50% retracement of the latest down leg from 93.87 to 92.63 so far, would provide a temporary relief. However, we need to see further extension higher and regain of minimum 93.87, pardon, 93.45.50 levels approximately here in order to confirm that the downside remains intact and the break lower was false, and of course to shift focus again towards 93.87 and then 94.00 with the 4 hour structure still seeing a more focus towards the downside. As long as we are below 93.23 as initial barrier, I would say more risk is seen for extension to 92.48 and then 92.15.00 now our near-term downside targets. If we start with the 4 hour chart, then we'll have a better picture. The uptrend there remains intact as 4 hour indicators remain in the positive territory with the recent pullback of 23rd of January high at 96.90 being contained by ascending 55 days exponential moving average at 95 zone that offered good support. This is also equivalent approximately to the previous highs of mid-January, and subsequent bounce higher so far reached 96.66, seeing a good position for a further extension higher as the hourly studies broke above midlines, but still lacking strength and lacking momentum for some stronger action. But overall tone is still positive, and as long as we are holding above 96 and 95.75, this is overnight's low, more focus is seen towards the upside. Of course, clearance above 96.66 is to open 96.90 for possible resumption of the larger uptrend, and the test of 97.00 as our next target, with the 96.79. This has already been tested. We have it somewhere. 97.82 is the 61.8% retracement of the larger 110.53 to 77.27 descent, and basically this is still our upside target, as daily structure is still quite positive despite some overbought readings. Still sees more room on the upside, with near-term focus still standing at 100, the psychological $100 per barrel. On the downside, then only loss of 95.00 handle would delay bulls and allow for some stronger corrective action that will open 94.12, 92.41 Fibonacci supports, and 92.64 higher base lows of beginning of January 2013. And finally, gold, that is under strong pressure. We can see better this on the 4-hour chart. Failure to break above 1694 and the 1700, congestion of a couple of days seen here, and subsequent reversal lower. Now see potential for some stronger corrective action that is basically already underway, and the signals an end of the third wave that commenced from 1653 and failed to reach its initial target at 1706 Fibonacci 100% expansion, with subsequent reversal so far retracing nearly 50% of the rally from 1625 to 1697, as the price lost traction. I would say more focus now seen towards the downside, as we lost also the important 1666 17th of January spike low and 1664 previous consolidation range floor, with 1663 seen so far just ahead of 50% retracement at 1661. Sees more focus towards the downside, with the near-term studies in the negative territory supporting the notion. As we can see, the corrective action was capped at 1672, leaving not much room for any stronger bounces. Risk on mode is back among the traders, and of course most of investors are jumping into more profitable and risky assets, leaving the safe haven once. And basically this was one of the main reasons for the recent weakness of yellow metal, as positive data came in past a couple of days to increase the risk appetite, and signaling, giving initial signal for swifter and stronger recovery of the world economies. On the upside, 1675, 38.2% retracement offers good resistance. Then we have 1677 descending 55 days exponential moving average, while on the downside, break below recent low at 1663 and the Fibonacci support at 1661 is expected to open the next strong support, previous higher base, and 61.8% Fibonacci retracement at 1650 zone. That will completely shift the focus lower and bring bears fully in play for a possible return down towards 1625, recent low posted on 4th of January 2012. And that will be all from my side. Your turn to submit your questions. It seems that we are all okay today, and we have no questions. In any case, if there is no questions, then I will just bring your attentions to the economic indicators releases that we already mentioned. IFO business climate in Germany at 9 o'clock, and GDP from UK at 9:30, seen as the key today's releases that might give cause some stronger market action, and of course focus on the levels important for the major, especially for euro. Weekly close above 134 would be good signal for stronger recovery, while weekly close below 158 for sterling would be again signal increased pressure and possible extension down towards 157. And that will be all for today, Friday. I wish you nice last day of the week, of course, with a lot of profits in your trading, and a nice and relaxing weekend. And we're back next Monday, 28th of January 2013 at our regular time at 8:00 GMT, 10 o'clock local Cyprus time. Good luck.